If you're holding Bitcoin, Ethereum, Solana, XRP, or any of these 12 other tokens, the SEC just ended nearly a decade of legal uncertainty in your favor. On March 17th, the SEC and CFTC released a joint guidance that classified these as commodities. And the years of Gensler treating everything as a security by default are officially over. But if your holdings go beyond those 16, this same guidance has some things that you need to hear. So the guidance puts every crypto asset into one of 5 categories. Digital commodities are tokens that function as the native currency you need to use a blockchain, like needing BTC to use Bitcoin or ETH to use Ethereum. Digital collectibles are NFTs and meme coins, things people buy for culture or entertainment rather than expecting investment returns. Digital tools are functional assets like domain names or event tickets that happen to be on-chain. Stablecoins are split between payment stablecoins that comply with the Genius Act and get a safe harbor, and algorithmic or yield-bearing stablecoins that might still be treated as securities. And then finally, digital securities are traditional financial instruments like stocks or bonds that just happen to be issued on a blockchain. Now, why do the categories matter? Well, because securities and commodities are regulated completely differently in the US. If something is a security, you need SEC registration, disclosure filings, investor protections, and the exchanges that list it need securities licenses. Spot commodity markets have far less regulatory overhead, which means crypto exchanges can list these assets without the compliance infrastructure that securities require. So the SEC explicitly named 16 tokens as digital commodities: Bitcoin, Ethereum, Solana, XRP, and then 12 others including Cardano, Chainlink, and Dogecoin. Now, if you're looking for a clean logic that explains why these 16 made the cut, you're not going to find one. The guidance talks about tokens separating from security status once the original team delivers on what they promised, but not all 16 fit that description neatly. Some of these were created without promising anything at all. So the list, it is what it is. Now, what matters practically is that before this guidance, a fund manager looking at any of these had to factor in the risk that the SEC could show up and call it a security. Compliance departments saw that uncertainty and stayed away. Now that question is answered for these 16, and the capital that was waiting for clarity can start moving. But only for these 16. There's no application process, no timeline, and no way to get the SEC to confirm any other token has crossed the line. So these 16 have their status locked in, and everything else is in a gray zone. So this framework creates a strange outcome. If the path to security status runs through promises a team made, then never making promises keeps you clear of it entirely, which is exactly why meme coins landed in the digital collectibles category alongside NFTs. The SEC defines this category as things people acquire for entertainment or cultural purposes. No registration requirements, no disclosure rules, completely legal. So you end up with a situation where a meme coin with zero utility has less regulatory risk than a DeFi protocol that's generating real revenue and building actual infrastructure. The protocol team made promises, talked about roadmaps, outlined what they were going to build. The meme coin team said nothing. So under this framework, saying nothing is actually the safer legal position. For your portfolio, the question becomes pretty direct. Are you holding tokens because a team promised to build something? Because if yes, you're potentially exposed to investment contract risk that the meme coin sitting next to it in your wallet doesn't have. Now, some actual good news. Protocol staking just got explicit legal clearance, and this matters because it's been a gray area for years. Whether you're running your own validator, delegating your tokens to someone else's validator, using a custodial service that stakes on your behalf, or holding liquid staking tokens, all of it is cleared. Bitcoin mining got the same treatment, whether you're solo mining or in a pool. That's not a securities transaction either. Airdrops also got cleared, but with an important limitation. If you've been using a protocol and they airdrop you tokens for that prior activity without announcing it beforehand, that's not a securities transaction. But if an airdrop is announced in advance to incentivize you to do something, complete tasks, retweet posts, refer friends, that's not covered by this clearance. And then there is restaking, which the guidance explicitly doesn't address. Now there's a footnote that says this release doesn't cover it. So the entire liquid restaking ecosystem is operating in regulatory limbo, while regular staking just got clarified. So staking is covered, but if you're earning yield from governance tokens rather than from validating the network, that is a different situation. We've established that team promises can create investment contracts. But what happens if you're already holding a governance token and then the protocol turns on revenue sharing to token holders? If the team is simultaneously talking about how their work is going to drive those fees higher, the token could flip into securities territory. The line the guidance draws is between automated protocol mechanics and team-driven profit expectations. Revenue flowing through code that just does what it does can stay clear. But revenue sharing combined with a team talking up how their work is going to grow those fees, that combination could trigger reclassification. And if that happens, you're looking at potential exchange delistings, compliance costs eating into your yield, and reduced liquidity. So if you're holding tokens for the yield, the question isn't just whether the APY is good, it's whether that yield is worth the risk that the token providing it gets reclassified while you're holding it.
Even a crypto asset that is not a security may become subject to the federal securities laws if it is offered and sold as part of an investment contract.
So that is what March 17th delivered. And the question now is whether it will stick. This is interpretive guidance, not actual law. The Clarity Act would make this framework permanent, and it's already passed the House, but the Senate has a narrow window to act. There is a banking committee markup scheduled for mid to late April, and if the bill doesn't clear that hurdle and reach a floor vote before June, it will likely get pushed to 2027. Until that happens, a future SEC could theoretically take a different position. Now, one more thing worth knowing, even with the SEC stepping back, private parties can still bring lawsuits claiming a token is a security, and the guidance doesn't prevent that. So, going forward, pay attention to whether the Clarity Act gets signed.
I'd love to see the Clarity Act pass the Senate before the end of the year.
And watch how the projects that you're holding talk about their roadmaps and revenue. Because under this framework, what teams say matters just as much as what they build. So we're curious, after going through this, which of your holdings are you looking at differently? Let us know in the comments.